Is this the big short for gold and silver, a market on the edge? Have you ever wondered what it looks like at the precipice of a significant market shift, not on a trading screen but on the ground floor of the real economy? Imagine a line of people stretching out the door of a bullion dealership not to buy the dip, but to sell the stack they have spent years or even decades accumulating. This isn't a theoretical exercise in market dynamics. It's a tangible, unfolding reality that forces us to question the foundational beliefs of many hard asset investors. Is this the tremor before the earthquake, or merely a localized adjustment in a sea of economic uncertainty? The prevailing economic condition we are witnessing is one of profound contradiction. For years, the gospel of precious metals has been preached as a hedge against inflation, a store of value in tumultuous times, and a ticket to ride the next great bull market. Yet here we see the faithful, the long-term holders, converting their metallic security back into fiat currency. This presents a critical problem for market analysis. Is the fear of an impending crash so great that even gold and silver seem risky, or is the need for immediate liquidity, for cash, so overwhelming that it forces the sale of one's core financial insurance policy? The catalyst for this exodus from precious metals is not a single dramatic event, but a confluence of powerful, personal, and macroeconomic pressures. For some, it is a strategic maneuver, a desire for cash flow without the tax consequences that come from traditional distributions, especially when one is on the cusp of a higher tax bracket. For others, it is a classic portfolio rebalancing, rotating out of one tangible asset that has seen significant appreciation into another, such as real estate, with the hope of future growth. This is not panic selling, it is calculated financial planning playing out in real time. The tipping point arrives when the anecdotal evidence becomes a visible trend. When a dealer who has observed the market's ebb and flow for years notes that sellers are beginning to outnumber buyers, it signals a potential sea change in market sentiment. This is where the theoretical meets the practical. The abstract fear of a market downturn becomes the concrete action of liquidation. This shift is further amplified by the very nature of the market itself, where a rapid price increase, as seen in silver, makes the asset vulnerable to a massive short, creating a self-fulfilling prophecy of price decline for those who hesitate. The immediate impact of this trend is a sudden influx of physical supply into the local market. While this might not move the global spot price needle, it creates a buyer's market at the retail level, altering the delicate balance of premiums and dealer inventory. The aftermath for the seller is a mixed emotional bag. There is the psychological pain of parting with a long-held asset, coupled with the relief of having liquid cash to deploy for other needs or investments. This scenario forces a reevaluation of the role of precious metals. Are they a permanent holding or a strategic reserve to be used when other opportunities or necessities arise? The ultimate takeaway from observing this phenomenon is a crucial lesson in the reality of tangible asset ownership. Investing in physical gold and silver is not a passive activity. It involves understanding market cycles, being aware of tax implications, and having a clear strategy for both acquisition and liquidation. It underscores the principle that all investments, even the most ancient forms of money, are tools to be managed. The line of sellers is not necessarily a sign of the apocalypse, but a powerful reminder that in finance, as in life, conditions change, and the wise investor is the one who adapts. Within this complex tapestry of market movement, the specific assets being transacted tell a story of their own. We are not just talking about generic 1-ounce rounds. We are witnessing the sale of pre-1933 double eagle gold coins, specifically Liberty heads. These are not mere bullion. They are historical artifacts, pieces of a bygone era when gold was constitutional money. For a collector or investor to part with a significant number of these coins, graded at a very respectable MS-64, indicates a powerful motivation. It suggests the need for capital is substantial enough to justify selling assets that carry both numismatic and intrinsic value. The discussion around the grading of these historical coins opens a window into one of the most subjective and debated aspects of the numismatic world. A grade of 64 for a Liberty head is considered high because these coins were workhorses of the financial system. They were used in large transactions, transported in canvas bags, and handled by bankers and wealthy individuals, inevitably picking up abrasions and scratches along the way. Unlike their more pristine St. Gaudens counterparts, which were produced closer to the 1933 confiscation, these Liberty heads lived a life in circulation, making a high-grade example a true survivor of commerce. The dealer's perspective on grading introduces a healthy dose of professional skepticism. He notes that grading is, at its core, an opinion. While third-party grading services like PCGS and NGC provide a standardized framework, the final determination is made by a human evaluator. The dealer, in his own assessment, would not have graded all the coins as 64, highlighting the subtle differences in wear and eye appeal that can lead to honest disagreements. This is a critical insight for investors who often treat the grade on a plastic slab as infallible truth rather than an expert, yet still subjective, opinion. This subjectivity in grading becomes particularly important when dealing with high-volume transactions. The seller, having purchased these coins online, placed their trust in the dealer and the grading service's reputation. However, the buyer, the local coin shop owner, uses the stated grade as a starting point for his own evaluation before making a multi-thousand-dollar purchase. This negotiation, rooted in differing expert opinions on the same physical object, is the essence of the numismatic market. It is a dance of trust, expertise, and financial risk that determines the final price for these tangible pieces of American history. The conversation also peels back the curtain on the operational realities of running a bullion business in the modern regulatory environment. To operate legally, a dealer must have a robust anti-money laundering plan. This is not a mere formality. It is a comprehensive strategy to avoid facilitating illicit activities. The dealer's plan is a case study in risk mitigation, outlining a series of transactions and payment methods that are explicitly forbidden. This includes no online sales, no credit cards for gold, no wire transfers, and a complete refusal to engage with cryptocurrencies or foreign currencies. By restricting the business to in-person, cash, or check transactions, the dealer dramatically simplifies his compliance burden. This seemingly old-fashioned business model is, in fact, a highly sophisticated defense against the complexities and dangers of modern financial crime. The fact that his anti-money laundering plan was approved with remarkable speed indicates that regulators appreciate this clear, unambiguous approach. It creates a transparent and easily auditable business environment, which stands in stark contrast to the often opaque world of online and international bullion dealing, thereby building a foundation of trust with both customers and authorities. Furthermore, the local reporting requirements provide another layer of security and compliance. In this particular city, a history of stolen goods being sold to precious metal dealers led to a regulation requiring the documentation of all sales, including the seller's name, license number, and date of birth. This information is held by the dealer for a 30-day period, along with the physical items themselves. This holding period acts as a cooling-off window, allowing law enforcement time to investigate any reported thefts and potentially recover stolen property before it is melted down or resold into the broader market. It is crucial to distinguish these local ordinances from federal reporting requirements. While a cash purchase of $10,000 or more from a dealer would trigger federal reporting, the information collected during a sale to the dealer is for local police records only and does not automatically enter a federal database. This nuance is vital for customers concerned about financial privacy. The dealer's meticulous record-keeping serves a dual purpose. It complies with the law and protects the business by providing a clear paper trail in case of any inquiries, whether from the chief of police or a concerned customer. The issue of sales tax adds another dimension to the appeal of conducting business in a specific physical location. The absence of a sales tax provides a direct and significant financial advantage for customers. This creates a powerful incentive for buyers to travel to the store to conduct their business in person, reinforcing the dealer's business model. It also highlights the fragmented and often contentious nature of tax laws across different states, where cross-border transactions can create complex tax liabilities for both the buyer and the seller. a headache this particular dealer and his local clientele are fortunate enough to avoid. The conversation takes a darker, more cautionary turn with the introduction of a counterfeit 100-ounce silver bar. This is not a small-time fake. It is a sophisticated forgery stamped with the name of a highly reputable refiner, Johnson Matthey. The discovery is a chilling reminder that the risks in the physical precious metals market extend beyond price volatility. The dealer's use of a verifier, a tool that measures the metal's properties, revealed the fraud instantly. The bar failed this test as well as the more traditional ping test, confirming it was not genuine silver. The existence of such a high-quality counterfeit raises a critical question. Is it economically viable for criminals to fake silver on this scale? The answer, unequivocally, is yes. As the price of silver rises, the profit margin for creating and selling a convincing fake 100-ounce bar becomes substantial. This is a significant threat to the entire ecosystem, as these large bars are often viewed as a cornerstone of a serious stacker's portfolio. The incident serves as a public service announcement, a stark warning that no investor can afford to be complacent about verification. The dealer's professional handling of the situation is instructive. He has already informed the customer who sent the bar, and his recommendation is not to simply discard it, but to take it to a refinery. A refinery can perform a spectrograph test, a highly accurate analysis that will determine the exact metallic composition of the fraudulent bar. This is the definitive, scientific way to confirm the counterfeit and provides the owner with indisputable evidence. It is a methodical and responsible approach to a very disappointing and potentially costly discovery for the investor involved. This event shatters a common misconception that counterfeiters only target gold due to its higher value. The reality is that any valuable commodity will attract fraud, and as silver's value increases, so does the incentive to produce fakes. This forces every participant in the market, from large dealers to individual stackers, to become more vigilant. It elevates the importance of sourcing metals from reputable dealers and, whenever possible, independently verifying purchases. Trust is the bedrock of the precious metals market, and the discovery of a sophisticated counterfeit like this Johnson Matthey bar erodes that trust. The psychological aspect of the market is a recurring theme, articulated perfectly by the comparison of gold and silver's price movements. Gold is described as the caveman dragging silver around by its hair. This evocative metaphor captures the historical relationship between the two metals, where gold is the primary driver and silver often follows its lead, sometimes with exaggerated volatility. An upward move in gold at the end of a market day can pull silver with it, while a downward move can have an equally powerful or even more pronounced effect. This dependency is a source of both opportunity and frustration for silver investors. The notion of silver hitting $50 as a magic number is discussed with a sense of foreboding, almost as a bad omen. This speaks to the market's memory of past rallies and subsequent crashes. Major round numbers in any market often act as psychological barriers and targets for large institutional players. When a price flies up too quickly, hitting a key level like that, it becomes an attractive target for those looking to short the market, betting on a price decline. The rapid ascent creates vulnerability, making a sharp correction more likely as profit takers and short sellers converge. The healthy market behavior, as suggested by the dealer, is not a vertical price explosion but a period of consolidation. After a significant drop and a partial recovery, the ideal scenario is for the price to trade sideways. This sideways movement, or coiling, allows the market to build a stable base of support before attempting the next leg up. This pattern prevents the market from becoming overextended and susceptible to the kind of aggressive shorting that can trigger a cascade of selling, wiping out recent gains and damaging investor confidence for a prolonged period. The seller's personal financial strategy provides a compelling case study in the sophisticated use of precious metals within a broader wealth management plan. Her decision to sell is driven by the need to manage required minimum distributions from an IRA. By liquidating the physical gold, which is held outside of her retirement accounts, she generates cash without adding to her taxable income for the year. This is a savvy move to avoid bracket creep, where taking a distribution from the IRA would push her into a higher tax bracket, significantly increasing her overall tax liability. Furthermore, her strategy extends beyond mere tax management into active and diversified investment. The cash generated from the sale of gold is not destined to sit idly in a bank account. It is being used to purchase land in Paraguay. This represents a transfer from one tangible asset to another, a strategic decision based on a long-term belief that the land investment will yield significant returns over the next decade. This diversification into foreign real estate is a sophisticated play, hedging not only against domestic market volatility, but also against potential currency and political risks. The discussion veers into the politically charged territory of a potential wealth tax or unrealized capital gains tax. This is a significant concern for any individual holding appreciated assets, whether they be stocks, real estate, or precious metals. The mere possibility of such a tax can influence investment decisions, potentially encouraging investors to realize gains under the current, more favorable tax regime rather than risk a punitive future tax. The seller's liquidation can be seen, in part, as a preemptive move to lock in gains and convert them into another asset class before tax laws potentially change. The interaction between the customer and the dealer, built over a nearly 7-year relationship, highlights the importance of trust and familiarity in the local coin shop model. The customer initially found the dealer through online videos, but the relationship was solidified through repeated in-person transactions. This is the competitive advantage that a local brick-and-mortar store has over faceless online retailers. The ability to look the dealer in the eye, have an open conversation, and build a long-term rapport creates a level of confidence and loyalty that an e-commerce platform cannot easily replicate. This personal relationship allows for a degree of flexibility and negotiation that is absent in standardized online transactions. The dealer agrees to purchase 10 of the gold coins, but only if he is allowed to pick them himself. This is a negotiation between two knowledgeable parties. The seller trusts the dealer's expertise to select the coins that best fit his inventory needs, and the dealer trusts the seller's understanding of the market enough to engage in this personalized transaction. It is a testament to the strength of their established business relationship, turning a simple sale into a collaborative process. The entire scene serves as a powerful microcosm of the larger financial world, where human psychology, personal relationships, and macroeconomic forces intersect. The line of sellers, the debate over a coin's grade, the discovery of a counterfeit, and the strategic financial planning all paint a picture of a market that is far more complex and human than a simple chart of spot prices would suggest. It is a living, breathing ecosystem where every transaction tells a story about an individual's hopes, fears, and strategic calculations in the face of an uncertain economic future. Ultimately, the day at the coin shop is a lesson in the duality of wealth. The customer parts with 20 historic gold coins, a significant store of tangible value, and receives a stack of fiat currency in return. The exchange is almost symbolic. The dealer wryly notes that it is only fiat, but immediately acknowledges its utility, stating that if you cannot turn it into gold, you can turn it into food, clothing, or, in this case, another promising investment. This highlights the fundamental purpose of any asset, to eventually be converted into something of use or value. The final takeaway is one of profound financial pragmatism. The decision to hold or sell an asset like gold is not an ideological one but a practical one, based on individual circumstances, goals, and an assessment of the current market landscape. The seller in this story is not abandoning her belief in hard assets. She is actively managing her portfolio to optimize her tax situation and pursue new opportunities. Her actions and the bustling activity at the coin shop demonstrate that the most successful investors are not dogmatic. They are dynamic, responsive, and always prepared to adapt to a changing world.